Ladies and gentlemen, good morning and welcome to the Q2 FY21 results call of JINDALSAW Limited, hosted by Emkay Global Financial Services. We have with us today on the call Mr. Neeraj Kumar, Group CEO and Whole-Time Director, Mr. Vinay Gupta, Global Head Treasury, and Mr. Narendra Mantri, Head Commercial and CFO. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions at the end of today's presentation. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anas Dadarkar. Thank you, and over to you, sir.
Good morning, everyone. I would like to welcome the management and thank them for giving us this opportunity. I would now hand over the call to the management for opening remarks. Over to you, sir.
Good morning, investors. Good morning, friends. I hope all of you are doing well and keeping healthy. The pandemic still seems to continue. It's coming in waves. As you know, in Delhi now we are witnessing a new high around 7,000, but luckily all of us are safe. All the plants of JINDALSAW is working. All our offices are functional. So the strict protocols that we have put in place has helped JINDALSAW as a multi-location, multi-division, multi-product organization to work to the best at its ability in the given scenario. I am happy to report that none of our plants have lost or have had any major interruptions due to this pandemic. So that's something which is good for us. We feel happy about it, and we would request all the investors to take note of it. Yesterday we had our board meeting and we have declared our quarterly results, which is the second quarter results. Looks like, barring some unforeseen or very difficult scenario resulting out of the pandemic, it appears that the negative impact of pandemic is behind us. This quarter we posted a standalone result. I'm just going to highlight a few things and then also give you one or two very significant developments on the consolidated results, because it does show a trend. There has been a reversal and we will talk about it. So this quarter we had a gross income, a top line of 2,021 crores as opposed to 1,400 crores in the first quarter. So the businesses have started picking up. The EBITDA number for this quarter is 295 crores, PBT 112 and PAT 74 crores. Important to note, as we have said, we have cleaned up our balance sheet, so we don't expect any exceptional items to come during this year in our standalone balance sheet. Now, important to note is if you look at the consolidated results, top line 2,446, EBITDA 349. Now that is something which I would like to draw the attention of all our investors. That standalone EBITDA 295 and consolidated EBITDA of 349. So there is over 50 crores of EBITDA which has been added by the subsidiaries and JINDALSAW Group companies, largely on account of now Abu Dhabi unit, our Abu Dhabi DI unit beginning to do well. In fact, the prognosis, the hope is this year the Abu Dhabi unit should perform the best ever for Abu Dhabi. So it is beginning to do well. We have a healthy order book. The productions have stabilized. The dispatches are happening, and things are beginning to look good for Abu Dhabi unit. The US unit, because of the elections, economy, and oil and gas demand or the prices is not as good as it used to be, but overall the EBITDA figure has consolidated EBITDA has an addition of over 50 crores largely from Abu Dhabi. Even at the PAT level, if you see, there is an increase from 74 to 80. So this is something that is for our investors to note, that now at all levels, whether it is at the top line, EBITDA, PBT or PAT levels, the other businesses or other subsidiaries, associates of JINDALSAW who are included in the consolidated results have started contributing positively, and we hope and expect that this trend will continue. That's about the results. A few things that I wish to also highlight. You would see there has been a reduction in the overall debt scenario. There has been a reduction on the financial charges scenario, so the balance sheet continues to remain strong. Good thing that I wish to highlight again, that even during this pandemic scenario, our receivables have stayed under control. We have been collecting our money on the old outstanding dues have also been collected. So the receivables continue to be under control. The inventory continue to remain under control. There is no major capex that we are incurring. There is no major projects that is on the anvil. So that should give you the sense that on the balance sheet side also, there is a status quo standstill or improvement in the working capital management for the company. Looking forward, if you see, we have during the quarter added a lot to our order book. In fact, the order book during this quarter has gone up in spite of we supplying goods worth 2,000 crores. So that again gives us an indication that the economy is beginning to open up, the demand is beginning to come. Among them, the significant ones for us are the stainless seamless business, because the stainless seamless business, as you know, is a new business. We are a new entrant. We have received a few important certifications, accreditations. The first order that we and Hunting got together for 13 chrome supply of 13 chrome pipes is under execution, and we are happy to let you know we would execute it within time and meeting all quality specifications. So on the seamless business, we do see and we are hopeful that things should begin to improve as we go forward. Water segment is an important segment for us because we have our large dia spiral pipes as well as DI. DI business continues to do strong. Most of the states are coming out with their own water grid system, which has given rise to demand both for our spiral pipes as well as for DI pipes. In oil and gas sector, in spite of the fluctuation of the international oil prices, at least in India, the demand for pipes for oil and gas continues to stay stable. In fact, now we are also working on the within city gas pipeline. This is one area where we have not focused our attention as yet. Now we are beginning to look at catering to this sector as well, because as you know from our Nashik plant, we can make seamless pipes up to 16 inches in diameter. So the IGL, the gas pipelines within the city, they fall within that range. We will try and address that segment as well. Pellet this year, because the way the iron and steel industry is behaving, continues to do well. In fact, the average contribution from pellet business has shown improvement in this quarter, and we expect that strength or strong performance would continue. The average EBITDA on the pipe is marginally lower than what it used to be because the oil and gas and water, the water segment supplies has been higher than the oil and gas, and therefore there is a marginal lowering of the EBITDA. But overall, we are maintaining the EBITDA above 14.5% of the top line within the quarter as well. Hopeful for the next 2 quarters, and we are confident that our strong performance will continue, wherein we would be able to maintain a very healthy order book. We will be able to maintain all our banking relationships. You would be happy to note our credit rating of AA has been reaffirmed. So with these initial comments, let me stop here and invite you to ask some clarifications, questions, or whatever that you may have. Thank you very much.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, if you wish to ask a question, you may please press star and 1. The first question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Good morning, sir, and thank you for the opportunity. Hope all well, sir, as you have already elaborated. Sir, firstly, sir, we did feel the impact of monsoon for this quarter in the LTD and the DI pipe segment. So, sir, how are the deliverables going to look for H2, sir? And can the December quarter can be on a likewise comparable basis with last year December quarter numbers?
Yes, this quarter, as you know, we are growing, or we were just coming out of the first quarter, which was a near washout because of the lockdown, etc. The second quarter, on one side, there was a positive thing on coming out of that, but did have a dampening effect because of the monsoon. Third quarter should be comparable to the third quarter of last year, with maybe marginally on the lower side, but we are confident that the fourth quarter for this year should be a typical fourth quarter for JINDALSAW. As you know, the fourth quarter businesses are always the best or the highest because of the budgets, because of the government push to complete whatever projects, implement whatever projects. So we expect Q3 to definitely improve, come close to the Q3 last year. Q4 we expect it to be a normal quarter for this year for JINDALSAW.
And sir, what reason you mentioned, sir, why Q3 will be lower than last year Q3?
Because we are still on the ascending curve. If you see, the second quarter was better than first quarter significantly, and we continue to build up, we continue to grow. So there, we expected it to come very close to the third quarter of last year, but maybe it will be a little marginally lower. Right. But it should be very close.
Sir, we have seen this raw material prices, especially the HR coil prices, moving up. So, sir, how would these impact our businesses going forward?
Two things. A, most of the time, the moment we get a project, we try and block our entire raw material, essentially to hedge ourselves against these situations. But still, if there are some open positions, there would be a marginal squeeze in our EBITDA, but very soon all this will get passed on to the customer. So there is a movement in steel prices, which on one hand is helping our pellet prices to go up and has already shown the contribution. And we are taking steps to minimize its impact on our large diameter business, which is the where we use coils and plates as a raw material. Most of them already has, if you look at our working capital utilization, we have placed orders, we have opened letter of credits, so we should be able to hedge ourselves on the raw material prices.
Sir, now just putting forward to page number 7, sir, JINDALSAW growth strategy, wherein you have very well articulated that the company is making conscious effort to move towards value-added products and penetrate new markets and increase production and productivity. And also, sir, about this investment have been judiciously being increased in higher ROC segment while de-subsidizing loss-making entities in its port. Sir, if you could give some more understanding what is going to be followed ahead, sir, and a very just a continued point to it, sir. Sir, if I'm not wrong, sir, this exercise, Neeraj sir, you started sometime way back in 2016-17. If I'm not wrong, at that time you did push investors like us that these loss-making subsidiaries are going to get de-subsidized in a phased manner, and you have walked the talk, sir. But sir, to the hardship of investors and shareholders, we have found that post this process of de-subsidization of loss-making subsidiaries, the investors which used to had the confidence and had made investment in JINDALSAW, I'm talking about the mutual funds, namely Life Insurance Corporation, Reliance, and other people. Everybody have exited, and as on today, sir, if I am not wrong, in the public domain, September quarter shareholding pattern is there. Even after all the efforts being made by the management team, where is this disconnect, sir? This is turning out to be a very frustrating point for investor communities, investors like us, who have definitely put the trust and the confidence on you. Sir, you are working for your four, five people, your customers, your bankers, your employees, and your shareholders. So your bankers are happy, your rating agencies are happy, your customers are happy, your suppliers are happy. What about the shareholders, sir? The shareholders are getting a dividend payout of 2 rupees after a period of 18 months. Other than that, there is neither any share appreciation, there is no interest at all. Neither any mutual funds, nor foreign institutions, nor anchor investors never participate in the growth story. Even sir, after promoters of JINDAL category holding 63% stake in the company, this is a very big dilemma, and this is putting questions on the credibility of the professional team run by you itself. This is my observation, sir. This is nothing to point out or to be any sarcastic, but this is what the real picture in front of you, sir.
Very long question. Let me just take it one by one. And you have highlighted a few things. First, you talked about reorganization. Yes, we had laid out a plan and we have moved on it, where the de-subsidization process is more or less complete. All the loss-making subsidiaries, all the non-related businesses, except for the JITF or Jones, which has been kept there only for the strategic region where the contract requires JINDALSAW to remain as a majority. Otherwise, and that's why in JITF, JINDALSAW owns 51%. Rest, all the non-related businesses, all the loss-making subsidiaries have been moved out, the last one being the Italian operations. So that's one part which is, we had laid out a plan and we have completed that. Second, if you see, there has been an improvement in the EBITDA margins on the top line as well, where we have steadily progressed towards an EBITDA in the range of 1,500 to 1,600 crores on a normal year basis. Third, there has been a steady again reduction and control on the debt of the company. So on all these parameters, where me, my professional team and the entire JINDALSAW have been working, we have shown a consistent progress in towards positive. Now coming to your question about we having 4 or 5 stakeholders where the banks seem to be okay with us, the rating agencies seem to be okay with us, the clients seem to be okay with us, the suppliers seem to be okay with us. But as you rightly pointed out, the shareholders at present are not seeing the value in this organization, and that can be seen straight if you see the net worth versus market cap difference. That does give indication that the shareholders do not see the value that is being created. Now the question is why? That is a question that we are also now beginning to focus on, and we are getting concerned because everything that needs to be done as an organization is being done. Maybe, now this is a maybe, there are still some legacy issues where probably now shareholders are waiting for the subsidiaries to start do well. Probably the shareholders are waiting for some consistent performance of the subsidiaries before they start seeing value. So I share your concern and I have the same empathy, and we will be working on it. We will try and reach out to the customers as things begin to open up, as our performance becomes more stable, especially from the subsidiaries. And we expect that there is a delay, but we expect the shareholders to begin to see the fundamental strength that has been created in the company, and we hope it should happen sooner than later. So I do share your, and I empathize with you, because this is something that we are also now beginning to focus on and getting some feedback from the investor community on where is the gap between the real fundamental strength of the company which has been created versus what is being perceived in the shareholder community.
And so lastly for LIC, I think so we have come with an
sorry to
LTD
interrupt,
issue.
Mr. Kapoor.
Yeah. I'll come in the queue, ma'am. Yeah, ma'am.
Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, we request you to limit your questions to 2 per participant only. As time permits, you can come back in the question queue for a follow-up question. The next question is from the line of Parthiv from NVS Brokerage. Please go ahead.
Yeah, hi. Good morning, sir.
Hi, good morning.
Good morning. So actually, I missed a couple of minutes in the starting, but I just wanted to ask, is your order book around 7,000 crores, I believe, when you convert to INR terms, right? Around.
Correct. Yes.
Yeah. So what is the timeline in which this would be executed? Like, what is the time frame what the company is looking at to execute this entire order book?
It is different for different products. As you know, large diameter pipes and DI pipes, the order book can stretch up to 9 months. And in the seamless business, typically the order book stretches up to 2 months to 2.5 months of delivery.
Okay.
The order book is more or less against delivery against cash. So we don't have a very large order book on pellet at any point of time.
And has the company seen any kind of, increase in order book receivables, like receiving the orders in recent months or recent days, I would say?
Yes, if you see the trend, second quarter, the order book, and if you compare it with what we have executed, there has been a net addition to the order book, and we expect that in the third quarter also that trend should continue.
Okay. And sir, when you told you have maintained 14.5% EBITDA margins, and quarter 3, quarter 4 would be on the same lines as that of last year. I was just doing a quick back of the envelope calculation. It looks the company looks very attractive when you just look at the valuation. But just a humble request as a shareholder, and just to carry forward Mr. Kapoor's point ahead, please declare a certain amount of dividend which is way above the thing what investors are getting as on date. That would actually build a lot of confidence into the company.
We take note of your points, and definitely towards the end of the year, when the question of dividend comes, we shall definitely deliberate upon it, and we will do whatever.
So either a dividend or a buyback, whatever is comfortable at that point of time. Please do have a look for the investors at large.
Okay, will do.
Thank you, and best of luck, sir. Thank you so much.
Thank you. The next question is from the line of Chirag Patel, an investor. Please go ahead. Chirag, your line is in the talk mode. Please go ahead. Chirag Patel, your line is in the talk mode. Please go ahead. As there's no response from the current participant, we'll move on to the next. That is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Good morning, sir.
Good morning.
Yeah. Sir, my first question pertains to our volume execution this year. So basically, if I remember correctly, at the start, we wanted to do almost a similar or slightly higher volume what we have done in FY20. So considering for second half, how do you see that in terms of delivery schedule? How do you see the volumes moving up?
If you just make that adjustment in the first quarter and second quarter a little bit because of the lockdown and the impact of pandemic, we are on Q3, Q4, there would be a catch-up, and providing for the adjustment for Q1 and Q2, we should be on track.
So should we maintain that kind of guidance of almost flattish volumes year on year, or it would be slightly higher as per current delivery schedule you have?
No, I would request you to look at more like a flattish performance, because, as I said, there is a catch-up that we have to do. Q1 has more or less been a washout, so I would indicate more towards a flattish performance.
Understood. So my second question pertains to our order book addition and the competitive intensity. Considering that now steel prices have been very volatile, I understand that we do back-to-back booking, but there's still a time lag of 15 days or a month before we do so. So how do you, would that, can we safely assume because of such a high volatility, there is a margin compression in terms of the new addition of order books, which is basically contributed by both higher steel prices as well as the higher competitive intensity, or more or less we are good in that account also?
See, I have already addressed this to some extent, that we, within JINDALSAW, there is a compensatory effect. Whenever the steel prices or the basic raw material prices in steel go up, our pellet division continues to do well. So the net impact, we do not see much, because A, we have a hedging strategy, B, there is a natural compensatory mechanism available within JINDALSAW. So we don't see much impact of the higher steel prices on our rise in raw material prices. However, one thing that you also must note is the breakup between supply to pipes for oil and gas sector versus supply of pipes to the water sector. The water sector typically gives a little less EBITDA margin than the oil and gas. But to put all of these in perspective, for JINDALSAW, we expect a stable EBITDA margin performance.
Understood. So just lastly, your targeted debt reduction, if you could share with us.
The debt reduction will follow its path in terms of whenever there is a debt reduction that is happening, will happen as per schedule, and we definitely expect the debt for the year end to even go down further. It is important for me to highlight here that now the term debt on the company's balance sheet anyway is on a lower side in terms of it is less than 2,000. It's somewhere around 16 to 1700 crores. The working capital, as I have always reiterated, our operations, trade finance is a part and parcel and very important aspect of. So the working capital utilization, as the operations go up, as the operations ramp up, will continue to stay there or will go marginally high. But term debt, we are absolutely confident that it is under control. We may have to do some profile correction in terms of trying to lengthen our repayment of the debt. So some profile correction is definitely we are looking at in terms of lengthening our repayment schedule. We are also looking at further reduction in our cost of capital on account of the credit rating that we have received. So all of you can expect some improvement in our cost of capital and a lengthening of the profile, which would further ease the liquidity pressure on the company. But overall, as I said, you should see a stable and a reducing debt trend for the company during the year.
Okay, sir. Thank you. That's all from my side.
Thank you. The next question is from the line of Sahil Sanghvi from Monarch Networth Capital. Please go ahead.
Yeah, good morning, sir. My first question is, can you give me the current utilization level of the DI plant, sir?
DI plant, we are operating upward of 80, I would say. Because again, see, in the pipe business, percentage capacity utilization is always with a lot of caveats, because it is how many times you are making changeovers, how many times you are making adjustments for the different sizes.
Right, sir.
DI plant is operating upward of 80%, will continue to operate very good. In terms of now, we are even expecting some orders in the export segment, because as you would have seen, the oil prices are beginning to harden. We hope that it continues and it crosses $50-60 if it is in that, because then the Middle East becomes very attractive in terms of, because those economies are all driven by the petroleum prices. So then we expect the DI to even start getting exported. So DI business, we are very, very confident that will continue to do well during the year.
Right, sir. My second question, and if Mr. Mantri could also answer this, we have been constantly seeing an increase in the order book for DI pipe. I think 2 quarters back, probably that number was around 5 lakh, and we've seen that going to 580, 579 lakh. So, can you throw some light on, where are these orders coming from, which states, and probably are you getting any kind of demand from the Jal Jeevan Mission, or are these state-specific orders?
See, Jal Jeevan Mission is being implemented through the water grids in the state. So the states where we have got some recent good orders are Maharashtra. We have got some very good win in Uttar Pradesh, because all these states are beginning to put a water grid, which is a part of the Jal Jeevan mission. So definitely the Jal Jeevan mission has begun to translate into states coming out with orders for pipes for the water sector, and definitely we are benefiting out of it.
Right, sir. Sir, any pressure you're seeing on the receivable front from these water projects, be it HSAW or DI pipes?
I have already addressed that in JINDALSAW, in fact, our receivables in terms of overall aggregate receivables, in terms of overdues, in terms of DSOs, everywhere in the last 6 months, lot of effort has been put and there has been an improvement on the three fronts. We don't see any significant write-offs or significant receivables getting stuck, because it's also important for you to note that a lot of our business, we do it against letter of credit. So receivable has actually never been an issue with JINDALSAW. We continue to have a very strong credit control system into our company.
Right, sir. And one last question was regarding our market share in the DI pipe segment. So a lot of our competitors are increasing their capacity, and even some of them in our region. So do we see any risk of losing market share in the DI segment?
In DI segment, we are confident that the market is growing, and the market is growing such that it would be able to accommodate all these, be able to absorb all these capacity expansion, etc. What we are confident of is that year on year we will continue to have our Samaghogha plant manufacture and supply close to or upward of 5 lakh tons per annum. That has been the trend and that would continue.
Okay, thank you, sir.
Thank you. The next question is from the line of Ritika Gupta from Equitas Investments. Please go ahead.
Hi, sir. Good morning. So I wanted to know, considering that most of our orders are now from the water sector, how do we see our EBITDA per ton trending?
As I have already mentioned, that the EBITDA per ton for the consolidated and for the entire pipe segment has already come down marginally.
Yes.
Which has been compensated by the increase in EBITDA in our pellet segment.
Yes.
So overall EBITDA margin of 14.5 is something that we are confident that we should be able to maintain.
Okay. So you mentioned that this is going to be the best year for your Abu Dhabi plant. So do we expect this run rate of 50 crores EBITDA per quarter to continue, or do we expect it to increase?
When you say the 50 crore EBITDA which has been added during this quarter, we expect this trend to continue.
Okay.
In terms of the year end, again, it would not be appropriate for me to give you the guidance on the exact numbers.
Yes.
But we are hopeful that the improved performance should continue for our Abu Dhabi facility as well.
So you think that it's going to improve from this level as well?
Now when you say this level, as I said, I wouldn't like to talk of numbers.
Okay.
The trend that we are showing will continue.
Okay. For my next.
And let me also tell you give you one more guidance which should help you. The H1 numbers for Abu Dhabi, and when you compare it with the H2 numbers of Abu Dhabi, and I'm mixing or I'm adding Q1, Q2 of Abu Dhabi, which is behind us, and the Q1, Q3, Q4 of Abu Dhabi, which is ahead of us, the H2 number should be better than the H1 number. That much guidance I can give you with a lot of confidence.
Okay. And so my last question is regarding return on capital employed. I understand that we have completed our reorganization plan to a large extent. So So do we have a target ROC that we plan to achieve, and by when do we plan to achieve it?
There I would request all the analysts and investors, please divide this analysis into two parts.
Okay.
Go back to 2015-16 when the process of reorganization, etc. started. Look at the incremental investment.
Yes.
Look at the incremental capital employed. Look at those incremental additions to the balance sheet and the incremental improvement in the P&L or EBITDA or the margins. So once you do that, then you will get a sense that in the last 4 or 5 years, how the incremental capital employed has resulted in what kind of margin. That's one analysis which is very important for all of you to do it, because that would give you the current situation, the current trend. But as you also know, JINDALSAW has a certain legacy. Even though we have de-subsidized, even though we have moved all of those for the current P&L, but having a legacy, it has a balance sheet size, etc., because of the legacy issue, which also we are making all effort to correct. The pandemic has delayed some of those correction initiatives that have been taken, but we are hopeful that all this should result into positive results very soon, and the legacy issues on the return on capital employed should also get arrested or should also get corrected very soon. So that's how I would request all the analysts to look at. Take 2016 as a watershed year. We are dealing with legacy issues. For future, we have already dealt with. For the past, whatever is there, there are definitive efforts to deal with that. As I said, and I repeat, because of the pandemic, some of those initiatives have been delayed a little bit, but we hope we will be able to catch up soon.
So do we expect any...
Sorry to interrupt, Ms. Gupta. Ma'am, may we request that you return to the question
Sure.
queue? Thank you. The next question is from the line of Navneet Bhaiya, an investor. Please go ahead.
Hi, sir. So my question is related to what the previous participant was asking. If I look at your fixed asset block of about 6,000 crores at the standalone level, and the turnover that you achieve with this asset block, the sales to fixed asset is a lot lower than a lot of your competitors, which I believe is the main reason for the return on capital to get reduced. I'm looking only at the standalone level. I'm not looking at the console level. So can you give reasons as to why the fixed asset block in our case is much higher, whereas your biggest competitor does the same turnover with roughly the same, with a much lower fixed asset base?
When you are looking at, I have already answered that in the previous question, that some of the balance sheet size is legacy that we are trying to correct. That's point one. Point two, when you are comparing us with our competitors, again, you have to be a little cautious and careful about finding a competitor which has as widespread product range as we have. So if you just choose a competitor who is in one segment of our business, your comparison may not be very accurate. But as I said, we are making efforts to correct this, and we should be able to correct it within a defined timeline. It all depends on how the pandemic, etc., starts opening up. ROC is something that we are definitely focused on.
Okay, so just to understand it correctly, the legacy issues are there in the standalone fixed asset base as well. Apart from what's there in the consolidated, there are some in the standalone books as well.
Capacities are there. For example, large diameter helical pipe, we have a lot headroom. So to that extent, if you see, on our helical business, is it operating at an optimal level so that it can, all the capital are throwing? The answer is not yet. So there are headroom issues, for example, in oil and gas also for our LSAW. Do we have capacity? Can we do better? The answer is yes. So when I say there are legacy issues, means there are capacities which at this point of time are not getting fully utilized and they are not throwing enough returns to justify those capital. And therefore, definitely there is a headroom for improvement in the EBITDA margin, etc., if we are able to operate at a higher capacity utilization, or if we are able to keep all our plants busy all the year round.
Okay, understand. And so the second question is, you mentioned to the volume guidance. So are we saying in FY21 the overall volume should be flattish as compared to FY20, as in including Q1, Q2?
When you are talking about FY21, you are talking about March 21 is what I presume. As I mentioned, that the guidance you should look at a flattish performance, but adjusted for the loss of business in Q1 and a marginal loss of business in Q2 because of the lockdown.
Okay, so overall we would be about 10% lower than last year in terms of volumes. If I just
won't like to comment on numbers, please.
Okay, no problem, sir. That's all from my side. Thank you so much.
Thank you. The next question is on the line of Shailesh Raja from B&K Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. So the total inventory amount was 2,100 crores. How much is raw material inventory and finished goods inventory there?
We will not have inventory, right?
I don't exact breakup of inventory on my desk, so you can I can answer that, or you can get it from our office.
Right. Okay. Yeah.
We'll give you, but what comfort I can give you is you would not find anything worrisome either in raw material inventory or finished goods inventory, all receivables. They are all within control. That much comfort I must give.
Okay. So in the pellet business, how was the spread, sir, in 2Q and how it is currently?
No, the pellet business is doing well. We are not having any stress in terms of the pellet business is doing well, both in terms of capacity. We are more or less operating at capacity, and we are able to sell most of our produce, and it is also giving us a higher margin than what it used to in the last year. So pellet business is doing well.
Okay. So could you please talk about stainless steel division, sir? What are the user industries we are targeting? Is 30K capacity fully stainless seamless pipes? Do we have backward integration facility? And what is the market size and market share we are targeting in next 3 years?
Stainless business, as you know, is a new business that we have entered. We are among the few who have put up a extruder of a large capacity, of large tonnage, and we have also got a few new accreditations. Namely, now EIL has approved our stainless COSI facility. That opens up a lot of opportunities for us. We also have created large capacity where we can become among the top 2-3 players in the country. Over the next 2 to 3 years, our effort would be to come within the top 2 or top 3 in the country in the stainless business, because we do see the synergy and the benefit we would achieve because of our carbon, alloy and stainless business in seamless pipes, seamless tubes, welded pipes in that segment together, because we are at present the only one who have all the 3 segments available to us. Because if you see the competition, they are present either in stainless or in carbon and alloy. We have the unique distinction of being present in all 3, and we wish to use that to our advantage over the next 2 to 3 years.
Okay, good, sir.
Sir, we are issuing the NCD of 500 crores. What is the rate of interest, please?
See, I have already mentioned that this is essentially to replace some high-cost debt, which is going to reduce our cost of capital. So definitely this is lower than what are some of the high-cost debt sitting on the balance sheet is. Also, this is a pretty long-term NCD where the repayments are back-ended. So I have already mentioned to all of you that it is going to correct our repayment profile, give us liquidity conservation opportunity for the next 4 to 5 years for sure, and would also help us in bringing down our overall cost of capital, because this debt is going to replace some of the high-cost bank debt that we already have on our balance sheet.
How much bps savings will be there, sir? 100 bps, 200 bps?
In terms of savings on 500 crores, we expect definitely close to a % saving in our reduction in our cost of capital.
Okay, sir. Yeah. Okay, sir. Thanks.
Thank you. We move on to the next question. That's on the line of Manish Bhandari from Valiant Capital. Please go ahead.
Hi, good morning. My question is regarding the what should be the total value-added percentage which you have been defining as a value addition as a turnover, and also maybe as a part of the margin enhancement in the next 2 years time frame?
2 years time frame is a good window to look at. If we are able to penetrate the stainless business the way we are thinking, if we are able to penetrate into the a few other initiatives that we have taken, we definitely should see a few percentage points improvement in the EBITDA margin for sure on an increased top line, because we are even expecting a improvement in top line on account of all of those. So on an increased top line, we expect a few percentages to be added to EBITDA over the next 2 years time frame, as you have asked, because we expect to enter some of these high value added segments.
So Neeraj, are you alluding that the 14.5% EBITDA margin should move in north of 16 to 17% on overall consolidated basis? Is that what you refer to?
We are hopeful that over the next 2 to 3 years we should be able to, assuming that we are able to successfully penetrate into the stainless steel and other high value segments that we are entering. The answer is yes, because this hunting partnership also should keep us in good stead.
Okay, and my second question is regarding what should be the total consolidated level cost of debt reduction, or maybe an absolute level for the interest rate decline which has happened, and you are one of the beneficiaries. So what should be the decline in absolute debt in next 2 years? Interest servicing.
See, interest rate I have already said, because of this 500 crores of LIC fund coming in, NCD coming in, which currently we are in the process of drawing down, we should definitely see a percentage point reduction in our cost of capital. As far as the reduction in the debt is concerned, I have already indicated that working capital will continue to keep track, or will continue to work along with the growth in business, growth in top line. On the term loan business, we will follow the repayment profile because of the kind of performance that we have. We have also seen the banks, we don't want to get into a prepayment penalty, or we don't want to get into increasing the cost of repayment of debt, because the banks are very comfortable with us. So we will follow the repayment profile that we have, which is roughly about 200 to 300 crores reduction year on year.
Neeraj, what I meant was that maybe the outstanding debt also would have seen a reduction in the cost of debt. total outstanding debt?
See, total outstanding debt, break it up into term loan is 17 and working capital is around 2,500 crores, in and around between 2,000 crores and 2,500 crores. So we are not talking about the working capital debt, which is between 2,000 and 2,500 crores, because that is going to track the operations. As operations go up, they will have to keep in pace there, because we have to book for raw material, we have to hedge for raw material, we have to provide for the receivables from the government, etc. As far as the term debt is concerned, there would be a correction at this point of time because of the addition of this NCD of 500 crores. After that, it will follow a reduction pattern, which is close to 200 to 300 crores year on year, and we expect that we will be able to continue that trend at least for the next 2 to 3 years.
Thank you. Thanks a lot.
Thank you. The next question is on the line of Saket Kapoor from Kapoor Company. Please go ahead.
Yes, sir. Thank you for the opportunity again. So just to deliberate on the NCD part, sir, what was the coupon rate, sir, you have mentioned, sir? I missed it.
It is less than 8% per annum.
Less than 8%. And sir, we are already having NCDs of 125 crore of 10.5%. So sir, are we going to make any prepayment on account of that, sir?
No, that NCD is there, but we also have, as I mentioned to you, some higher rate term loan from banks. We intend to replace them and get over to this NCD, because there are 2-3 good points about this NCD. A, it opens up a new source of raising debt for us because of the rating that we have achieved. So this is a new source. Second, it is a 10-year NCD with a back-end repayment. The repayment starts only after year 7. So for the first 6 years, we would be able to conserve the cash, and the rate for this entire duration is going to remain less than 8%. So these are the benefits that we see, and that's why we are going for it.
Okay, sir. And sir, currently, sir, we are seeing the CP market quoting less than 4%, and the way the markets are positioned, the money market, it seems that the interest rates are going to hover around lower levels only. So even at 7 and 8% also looks on the higher side. I just wanted to understand the thought process, the kind of cash flow which we are generating.
Let me address that for you. We also have got all the enabling provisions to mobilize money from the CP market. But please appreciate, CP market is volatile, is 90 days. This NCD is 10 years. So when you are looking at 10 years at a fixed rate of interest, it provides a different kind of a stability to your balance sheet. CP market, we have all enabling provisions we would be addressing, because now that market also is accessible to JINDALSAW because of the rating that we have received on the short-term papers as well. So we would use the CP market. We have used the NCD market. Both will help us bring down the cost of capital. CP market would essentially be used to support the working capital cost of funds. The NCD would be used to support the term loan funds and provide cash conservation opportunity for JINDALSAW. That's the overall, or I would say, the high-level treasury strategy that we will follow. So it's not that CP versus NCD. It is CP as well as NCD to reduce both long-term as well as short-term and create stability in the cash flow.
Thank you. Ladies and gentlemen, that was our last question. I now hand the conference over to the management for the closing comments.
Thank you, investors. As I say, it's really great that we see that all of you come on the call every quarter, but I do share your concern that our market cap is not what we all believe should be. It does not definitely reflect the fundamental strength of the organization that we have been able to build over the last few years. And we all hope, we empathize, and we expect that this should correct soon. I have taken note of some of the suggestions made in terms of dividend payout and a few other suggestions, valuable suggestions given by our investors. So I wish to thank all of you. We would take note of it and we'll try and work on it. Thank you all. Thank you very much. Bye.
Thank you. Ladies and gentlemen, on behalf of Emkay Global Financial Services, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines. Thank you.